Thank you, Daniel. Well, now that Daniel's talked about the importance of defining success for a hedging program and the trade-off between risk and reward, the next important thing to focus on is your time horizon for hedging. If it's within the next 18 months, I would classify that as short term. If it is 3 years out or more, I would classify that as long term. We categorize these time periods so we can focus on the relevant price influences to your hedging plan. As an energy professional, you receive lots of market news and data. The key is to focus on the issues that directly affect your strategies. And as you can see on the slide here, there's some news items in short-term, medium-term, and long-term types of news items that you might be very familiar with if you're monitoring the market. For example, a summer heat wave will boost short-term demand for natural gas to serve power generation load. That could be a positive influence on prices in the physical market in near-term futures months, especially if the hot weather is expected to last for an extended period. Why is that, you might ask? Well, sustained high demand could potentially impact the seasonal supply-demand balance, but it would not be expected to influence prices 3 years out. Conversely, back in May, the approval of the Freeport, Texas LNG export terminal that could begin operations in 2016 will not have an impact on short-term prices at all. But for those of you who were watching the market, you may have noticed that longer-dated prices rallied almost 30 cents in the days following that announcement. This brings us back to the time commitment and risk profile issues. For example, if you were a conservative customer with a low engagement level and budget objectives that were reachable when you renewed your contract, none of this could be relevant. You would have likely locked up a fixed price on day one. If you were a fuel buyer with a higher engagement level with aggressive objectives, a major summer heat wave forecast is something you wouldn't want to miss. In fact, it could prompt you to take action to manage your risk. This next chart I'd like to show you is the 3-year natural gas forward price curve. That is the NYMEX futures price of each month for the next 36 months out. And it shows some of the categories of news and data that can impact the prices, kind of in those little margins from the short, medium, and long-term time scenario. Most people operate in the short term, and market fundamentals like weather and storage are big drivers, along with hedge fund activity. Longer term, LNG exports, environmental laws related to gas production, and power generation have more influence. As you may or may not know, the curve extends out many years and tops out near $7 in 2025. At any instant, end users who face this price curve may decide to hedge to gain cost certainty and avoid exposure to higher prices. On the opposite side, producers are also very active hedgers, but they are managing potential downside risk. The structure of the price curve can provide a great deal of information about the market consensus. First, the natural gas forward prices are much higher than near-term prices. You can see that upward slope. That's commonly called the contango structure, and that tells us that there's confidence in supply in meeting current demand in the short term. But longer term, the collective market has less confidence, and sellers demand a risk premium to sell forward. Second, winter premiums are very slight, maybe 30 cents. You see the little bumps in the winter contracts. It is actually very slight. It's about 30 cents. This differs substantially from just a few years ago when they were well over $1. The short story here is that increases in production and new storage capacity have given the market more confidence in meeting peak demand periods. Third, changes in the curve are also very telling. The change in the summer-winter spreads over the years is a good example. If you paid a large premium to hedge winter exposure in the past, you'll notice that change in the market. Let's talk about a profound short-term influence. New Marcellus supply in the Northeast, and more broadly, shale production. The 3.5 BCF, that's billion cubic feet per day, production gain in 1 year to a total of about 12.5 BCF in the Northeast is staggering in a gas world that used to struggle to maintain supply, never mind grow it. The shale gale, as it's been called, has redefined the supply-demand balance, and has had a massive impact on price relationships for Henry Hub futures and basis, and led to a host of infrastructure projects. As the notations on the map suggest, the new supply in the Northeast has reduced the need for Canadian imports from Canada. You'll see that arrow on the top. Canadian imports are down 0.6 BCF, or 600,000 decatherms per day. It's also reduced the need for long-haul pipeline transport from the Rockies, which is the REX pipeline, and from the Southeast, and you see those arrows coming up from the south. Along with new pipeline projects to move it, these new supplies have substantially reduced costs and risks to serve a historically constrained market like New York City. By almost all projections, this supply will continue to grow, and the Northeast will be a net exporter within the next several years. What that means is some of those arrows that are being imported into the Northeast will be pointing outward as this Northeast supply serves other areas. Now, I've been involved in the natural gas forward markets for about 15 years, and for the first 10 or so, supply was locked in at about 50 billion cubic feet per day. It was a treadmill where new production would replace depleted or declining supply basins, and prices spiked whenever there was a supply disruption or an extreme demand period. Since 2007, that's all changed. As the chart shows, U.S. production has risen 30% from 50 BCF to 65 BCF since 2007. In particular, shale gas, which was less than 5% of supply 10 years ago, now accounts for well over 40%. As you may be able to see on the chart, the dark brown wedge is the Marcellus Shale. That's a growing section. It's the second from the top. And the blue wedge, Eagle Ford, which is on the top, have shown the most growth, while the red wedge, the Haynesville Formation, is still very significant, but starting to decline. As we will discuss, that 30% rise in flowing gas over the last 5 or 6 years has had a dramatic effect. It has reduced price levels, reduced price volatility, reduced the need for imports into the U.S., and it's changed the supply-demand balance. Now, remember where we started. I'd like to put that short-term supply picture in perspective. If a picture is worth 1,000 words, this chart of the continuous prompt month futures prices over the 20-year history of the NYMEX shows that the natural gas history breaks into 3 distinct areas. The 1990s were characterized really as a gas bubble. There was really more supply than demand, and prices were relatively stable and low. In 2000 to 2010, this is really what would be considered the natural gas-fired gas generation era. This is where low prices in the 1990s and the inability to site nuclear plants and coal plants led to a huge build-out of natural gas peaking and baseload plants for power generation. Natural gas became the marginal fuel to set power prices. Very expensive and risky deepwater drilling in the Gulf of Mexico dominated the supply side. As a result, prices were highly volatile, with price spikes north of $10 in several years. From 2010 forward, increased shale supply, mainly due to research and engineering that was financed by those high prices, led to what could be called a new era of relatively low and stable prices. Now, as a consumer of any product or service, an understanding of the supply-demand balance leads to an understanding of price. This chart has a lot of numbers on it, but the point is very simple. Balance is the key, and in 2012, the natural gas market was oversupplied. It was an oversupplied market that was compounded by a very warm winter. As a result, natural gas prices were the lowest since 1999, and you could see the number on the chart there, $2.79 a decatherm on an average, and that's of the monthly settlements of the NYMEX. Now, demand in 2013 has returned somewhat, and the market is more balanced, but prices are still the second lowest since 2002. So, more importantly, for hedgers, the forward curve, which you can see some of the prices on the lower right, and actually those prices have dropped somewhat since a couple days ago when we put the slide together, is less upward sloping than it used to be. That means there's less significant of a risk premium in future years. And those prices in future years are really not too much different than we saw in 2009 to 2011. Right now, 2014, as of the last, my view, was about 387, and 2017 was up to 431. Those prices kind of fit very well with the 2009 to 11 prices we saw before. Looking at expectations for the supply and demand balance helps explain why those prices are where they are. First off, as I mentioned before, domestic production has grown to 65 BCF a day. Where is all this supply going? Well, this chart shows the primary categories of demand and how they fluctuated during 2012. In January, residential and commercial demand, which is the yellow sector on the top of that chart, was about 40 BCF a day. You can see that's a difference between 40, that total of 40, and the top of 80. Industrial demand, which is shown in red, is relatively constant throughout the year. And power generation demand, which has grown to be a larger and larger portion of overall load, is in green. And you can see that peaks in the summer. Power generation load might vary from 20 BCF in some of the off months up to about 35 BCF per day in the summer. So what is that line? Now, there's a line on the chart. That's actually, I think, in the wrong spot. It should be at 65 BCF per day. That represents short-term supply, which for the intents of this program, we could say is stable. What that's telling you is that on peak winter days, say in January, when the average demand is 80 BCF and peak supply, or peak days might be more like 100, about 30 BCF or more must be taken from storage to serve that demand. And in the spring, summer, and fall, where demand is almost always less than 65 BCF a day, this extra gas is injected into storage. As I'm sure you know, the storage report on Thursdays at 10:30 are always big news. That's how we infer demand in the short term. And any expected shifts in the supply-demand balance, like a higher or lower than expected number, often moves prices. Also, just in one more thing about storage, in recent years there's been fear of supply maxing out storage. All this new supply came on, and if there wasn't enough demand to use it, supply caverns or storage caverns would fill and prices were expected to drop significantly. We've seen a lot of weakness in the late summer and early fall historically. This year, increased demand and increased storage capacity make that possibility extremely remote. And prices have held firm and rallied, primarily rallied since early August and until the last week or so where they've fallen back to about 350 or so in the front month. Looking specifically at demand for this year, it is up about 10% over 2012, led by the residential and commercial sector. It was much colder in the first quarter of the year, January through March, than last year. Industrial demand is also up, mainly because of that lower price and lower price volatility and the long time cycle to get some of these projects online. All this has contributed to the uptick in prices from that 279 average we saw in 2012. Power generation, though, is down about 10%, as the price recovery we spoke about has allowed lower priced coal in some regions to displace some gas plants that ran last year. As I mentioned, changes in the price curve can also be quite telling. This chart shows the same 36-month price curve we saw before, with this year in red, last year in blue, and 2 years ago in green. What are the trends? Short-term prices are up about 50 cents versus last year. You can see the red over the blue in the short term, but still below 2011. Longer term, confidence in the supply has reduced the premium in forward prices significantly, from about $5 to $4. And you can see the green line, certainly in the 36-month time period, was around $5 in 2011, more like $4 this year. So I think it's also important to determine what determines the prices for today or for next month. In other words, where do supply, demand, and price ultimately meet? In my opinion, in the non-winter months, especially, the power months are a huge influence. If gas is too expensive relative to power prices, demand will drop off, which suppresses further price gains. This helps form an upper price boundary. If gas generation is economic and gas is cheaper than other fuels like coal, gas demand could increase greatly, which should mitigate against prices falling much further. This coal-to-gas switching helps form a lower boundary for prices. In the winter months, overall heating demand, storage levels, physical constraints in the power markets all come into play. We've talked about massive supply gains and what drives the supply-demand balance in the short term. What are some medium and long-term trends? Well, first, longer-dated prices have been stable to down. All this Marcellus supply gains have been robust, and Utica Shale is the next basin really to come on to even boost supply further. What about demand? As we discussed, the growth from 50 to 65 BCF a day in supply has created some short-term imbalances in the market. But market forces actually do work. These low prices brought on huge increases in power generation, and prices have recovered. Let's look at some key demand components. This chart shows monthly power generation demand, which is in a 10-year growth phase. Low-priced gas, high-priced oil, plus the anticipated retirement of coal and nuke plants are all contributing factors to this continuing. But increased utilization of wind, especially in non-peak periods, are a threat to overall demand growth. Lower-priced natural gas price environment has resulted in a surge of industrial gas demand, like we spoke about earlier, and expectations for more growth. Interestingly, some prominent energy-intensive industries like chemical, steel, fertilizer, and paper are in growth phases and looking for ways to utilize low and stable natural gas prices. And they're all in the long-term cycle to plan, develop, and finance projects. All the new domestic production has changed the profile of overall supply in the U.S. In 2001, about 20% of domestic supply was from imports. Now it's about 5%. Down the road, the U.S. is expected to be a net exporter. Let's look at the main three components of this equation. The U.S. used to import 7 to 8 BCF per day from Canada. Now it's more like 4 to 6. This is mainly due to increased usage in Canada and also the fact that lower priced gas here is making it uneconomic to move the gas in. Their pipeline exports to Mexico have gotten very little attention compared to LNG exports that are proposed. They've grown to 2 BCF a day, and they're expected to double in the next 4 years. LNG exports are minimal right now, but more importantly, there are 4 approved export projects totaling over 6 BCF per day that could start in 2015 to 16. Another long-term factor to consider is transportation demand, which right now is minimal, but on a BTU basis, natural gas is dramatically cheaper than gasoline, and CNG, compressed natural gas, vehicles could represent a sizable non-weather influenced increase in baseload demand for natural gas. There are numerous initiatives, particularly in the heavy truck and fleet sector, that have very attractive economics, with payback periods on the order of 2 years that could come on a lot faster than people think. In fact, several of Tesla's major customers have projects in development. Summing up, the medium and long-term demand outlook is quite bright. As discussed, demand from the power, industrial, export, and transportation sectors represent major potential growth. For buyers, the good news is that the forward curve has been stable to trending down and flat. That is, lower prices and less risk premium. For those with longer time horizons and a conservative risk profile, longer dated prices look very attractive, in my opinion. So, in summary, we'd like to define our hedge objectives, risk tolerance, and time horizon, focus on the relevant news and that portion of the forward curve that you're interested in hedging, and understand what drives the supply and demand balance and the sensitivity of prices to manage your risk when managing your procurement in those areas. So, Daniel and I have given you a lot of information today. For anyone who may want to learn more, we provided a few reference sources and links at the end of the presentation. And I think